You've been told the restaurant closed because of changing consumer tastes. The real driver isn't what most coverage focuses on. Beneath the headlines, a different financial logic is operating, one that has nothing to do with the food, the service, or the neighborhood. You remember the booth, the smell of the kitchen, the waitress who knew your order. You watched that chain shrink over a decade, fewer locations, thinner menus, worse service, then a bankruptcy filing that made the local news for one day and disappeared. The official explanation described it as a casualty of shifting demand, rising labor costs, or market headwinds. That explanation describes the symptom. The mechanism sits elsewhere. Here is the pattern you've already noticed, whether or not you had a name for it. A beloved, cash-generating brand gets bought by a firm you've never heard of, and within 5 to 10 years it is bankrupt, even though people were still ordering the food. Financial historians call this the leveraged buyout cycle, applied to consumer-facing retail and dining, and it has a documented anatomy. Josh Kosman in The Buyout of America, 2009, traced how private equity firms used borrowed capital to acquire established companies, then loaded the acquired company itself with the debt used to buy it. The company you loved didn't take out that debt to expand. It inherited it as a condition of being purchased. That is the first structural fact you need. In a leveraged buyout, the target company's own balance sheet becomes the collateral and the repayment vehicle for its own acquisition. You see the acquisition announced, a press release, a photo of smiling executives, words like growth, innovation, next chapter. But the more important mechanism is this. The private equity firm typically puts down a small fraction of the purchase price in its own capital, often 10 to 30%, and borrows the rest against the target's future cash flow and assets. Eileen Appelbaum and Rosemary Batt in Private Equity at Work, 2014, documented this structure across hundreds of transactions. Their research found that the debt used to finance acquisitions is placed on the acquired firm's books, not the private equity funds, which means the restaurant chain itself, not the buyer, carries the repayment obligation. You watch the restaurant chain's debt load multiply almost overnight, even though nothing about its day-to-day operations has changed. Same menu, same customers, same kitchens, a completely different capital structure. Here is what that pattern historically produced. An operating company that now must generate enough cash not just to run stores, cook food, and pay staff, but to service interest payments on debt it did not choose to take on. And financial history gives this phenomenon a name: the leveraged buyout, formalized in the corporate takeover wave of the 1980s and revived at scale after the 2008 financial crisis, when interest rates fell and credit became cheap for financial sponsors. You assumed the value of a restaurant chain was in its brand, its recipes, its loyal customers. But often the most valuable asset on the balance sheet was something else entirely: the land underneath the restaurants. This is where the historical record becomes useful. When Golden Gate Capital acquired the seafood chain Red Lobster in 2014, it executed a sale-leaseback on the majority of the company's owned real estate, selling the land and buildings to a separate real estate entity, and then leasing them back to the operating restaurant business at a fixed, ongoing rent. You see the immediate effect. The private equity firm and its investors recovered a large portion of their purchase price in cash almost immediately, extracting the value of the real estate. The restaurant business, meanwhile, converted what had been a fixed asset it owned outright into a permanent, non-negotiable rent obligation. The deeper question is not what happened. The deeper question is why it keeps happening. The answer sits in the incentive structure underneath it. A private equity fund typically operates on a defined life cycle, often 5 to 7 years, after which it must return capital to its own investors, called limited partners. Extracting value early, through a sale-leaseback or a dividend recapitalization, de-risks the investment for the fund regardless of what happens to the underlying business afterward. Who benefits? The fund and its limited partners who recover capital early. Who absorbs the risk? The operating company, now carrying rent and debt obligations that did not exist before the transaction, and ultimately the employees and communities dependent on its survival. You notice a second pattern in these deals, separate from the real estate sale. Sometimes the private equity owner has the restaurant company borrow additional money, not to open new locations, not to renovate stores, not to improve the menu, but to pay a special dividend directly to the fund and its investors. This is called a dividend recapitalization. It is legal, it is common, and it has a specific effect. It increases the company's debt load a second time, years after the original acquisition debt, without adding any operating value to the business. Appelbaum and Batts research found that dividend recapitalizations were disproportionately common among private equity-owned retail and restaurant companies that later filed for bankruptcy, compared with similar companies that remained independently owned. You see the same entity, the operating restaurant chain, absorb debt from the original buyout, rent obligations from the real estate sale-leaseback, and now a second layer of debt from a recapitalization, all while its core business of selling meals has not fundamentally changed. Who gains liquidity in this sequence? The financial sponsor. Who gains time? The financial sponsor, which can now exit part or all of its position well before the underlying business's fate is determined. Who carries the cost? The company that must generate rising cash flow indefinitely simply to remain solvent. You assumed that once the deal closed, the private equity firm's compensation came only from eventually selling the company at a profit. There is a second, quieter revenue stream, the monitoring fee, sometimes called an advisory or management fee, paid annually by the operating company to the private equity firm for the ongoing guidance of the deal. Cosman's research on leveraged buyouts documented these fees as a recurring feature of the buyout structure, cash flowing out of the operating company to the ownership group every year, independent of whether the underlying business was thriving or struggling. You begin to see the full incentive map. The financial sponsor can generate returns through the initial buyout structure, through a sale-leaseback, through a dividend recapitalization, and through ongoing monitoring fees, several of which occur regardless of whether the restaurant chain itself ultimately survives. This is the structural logic behind a company that can look profitable at the store level and still collapse at the corporate level. The stores are selling food at a margin. The corporate entity is bleeding cash to rent, debt service, and fees layered on top of that margin. Myth: private equity buys struggling companies and turns them around. Reality: many of the highest profile restaurant bankruptcies involved chains that were financially healthy at the time of acquisition. Why it's false: the debt burden and real estate extraction were frequently the cause of the later distress, not a response to pre-existing weakness. Appelbaum and Batts' analysis of retail bankruptcies found debt-driven collapse, rather than operational failure, as a recurring feature of private equity-owned companies that filed for Chapter 11. Myth: bankruptcy means the private equity firm lost money too. Reality: because the debt sits on the operating company, not the fund itself, and because much of the fund's capital may already have been returned through a sale-leaseback or dividend recapitalization, a bankruptcy filing can occur years after the sponsor has already recovered its investment and profit. Why it's false: the fund's return and the company's survival are structurally decoupled once early-stage cash extraction has occurred. Myth: the chain declined because customers stopped wanting the food. Reality: same-store sales at many of these chains remained positive or roughly stable in years immediately preceding their bankruptcy filings. Why it's false: bankruptcy filings frequently cite fixed rent and debt service obligations specifically, not declining revenue, as the proximate cause in court filings. Myth: this only happens to badly run companies with bad management. Reality: the mechanism is capital structure driven, meaning it can be applied to well-run, well-loved, operationally sound businesses with equal effect. Why it's false: the debt and rent obligations are imposed externally by the transaction structure, not generated internally by day-to-day management decisions. What looked like a string of unrelated corporate failures across different restaurant chains, different cuisines, different decades, is actually a recognizable pattern with a name: financial engineering applied to operating companies through the leveraged buyout structure. Hyman Minsky's framework, developed in Stabilizing an Unstable Economy, 1986, described how periods of cheap credit encourage increasingly aggressive uses of debt across an economy, eventually producing structures that only remain stable if favorable conditions persist indefinitely. Applied to individual companies rather than entire economies, the same logic explains why a restaurant chain that appears stable during a period of low interest rates and steady consumer spending can become insolvent the moment either condition shifts. You see it now as a specific instance of a larger pattern: leverage applied at the level of a single operating company, where the debt is serviceable under favorable assumptions and unsustainable the moment those assumptions change, a rise in interest rates, a downturn in consumer spending, a supply cost shock. Carmen Reinhardt and Kenneth Rogoff, In This Time Is Different, 2009, documented across centuries of financial history that debt-driven collapses tend to look sudden and unexpected in the moment, and orderly and predictable in hindsight, once the underlying leverage is accounted for. Always focus on incentives, not intentions. Who gains liquidity? The private equity fund, through sale-leasebacks and dividend recapitalizations executed early in the ownership period. Who gains optionality? The fund's general partners, who can exit part of their position through these mechanisms well before the eventual fate of the company is known. Who gains political and reputational distance? The fund itself, which is rarely named in local news coverage of a bankruptcy or store closure, compared with the visible brand name of the restaurant chain. Who carries the cost? The operating company, whose balance sheet absorbs acquisition debt, real estate rent, recapitalization debt, and monitoring fees, layered sequentially over years. Who ultimately absorbs the downstream cost? Employees who lose jobs when locations close, landlords and suppliers left as unsecured creditors in bankruptcy proceedings, and communities that lose a long-standing local business, often with limited public visibility into why it happened. You cannot prevent a private equity acquisition of a brand you like, but you can read the signals before the story becomes a bankruptcy filing. Watch for a change in ownership announced with vague language about growth and new capital rather than specific investment plans. Watch for a subsequent announcement of a sale-leaseback of company-owned real estate, often framed as unlocking capital or operational efficiency. Watch for a dividend recapitalization, typically reported in trade press and financial filings, not consumer media. Watch for a rise in the number of company-operated locations converting to franchise-operated locations, which shifts operating risk to individual franchisees. Watch menu prices and portion sizes for changes that occur independent of input cost inflation, often a sign of margin pressure from fixed obligations rather than food costs. Watch employee reviews and turnover data, which frequently reflect cost-cutting before it becomes visible to customers. Read bankruptcy filings when they occur. They typically disclose in specific dollar figures the debt load, the annual rent obligation, and the fees paid to the ownership group, information rarely covered in consumer press. Understand that a restaurant's continued popularity with customers does not indicate financial stability at the corporate level. Recognize that private equity ownership itself is not inherently predictive of failure. The specific presence of a sale-leaseback and a dividend recapitalization together is the more reliable historical signal. Treat any acquisition announcement as the start of a new capital structure story, not the end of one. You are not watching a story about bad food or changing tastes. You are watching a recognizable financial structure play out, one with a defined mechanism, a documented history, and a predictable set of incentives. This is not a reason to distrust every business transaction. It is a reason to separate the operating story, the food, the staff, the customers from the capital story, who owns the debt, who owns the real estate, and who is positioned to exit before the outcome is determined. The next time you hear that a familiar chain has been acquired, or that it has filed for bankruptcy despite still having customers, you won't just be watching a company's story. You'll be watching the capital structure underneath it. If you want more videos like this, subscribe.